SPX here. If you guys have any questions, once again, around the market, more than happy to answer it. Hey, Duncan, Mirza, great to see y'all. Hello. Uh, we'll talk with CPI this morning, and then certainly we will go from there. So, starting with SPX, we did have a slight gap to the upside from where we closed yesterday. You can see that here on the intraday charts. Attempted to move higher, but didn't quite get going, right? We attempted to bounce up literally within that first 5-minute bar is where we hit basically the highs of the day. Then we started to pull back. We went down into intraday support levels. We gave a second shot of trying to get up towards the highs. Didn't even quite get all the way up there, right? We started to stall at 41.30, and then we reversed back down, and that reversal was a bit stronger, brought us down into 4100, broke that a little bit down into 40.95 for the lows today. And right now we had that bounce off that level, but as you can see, still a very choppy day. When we zoom out here on the hourly chart, you can see that we've been just kind of stuck in this range of consolidation. We can't quite get going to the upside, and yet we're not falling completely apart. Momentum right now on the hourly chart is going back into resetting some. We have a pullback signal on our low time frames. Momentum is below the zero line, which adds a little bit of that bearish weight. But to me, overall, this is still just very choppy. So unfortunately, CPI it didn't get us going. And for those of you who recalled CPI last year, we had a lot of move that announcement, right? I can even pick the days, like this is a CPI day where we gapped down and then had just shy of a 200-point rally to the upside. I believe this was a CPI day where we had a huge gap up and then had a close to 100-point daily range. And so that was more the commonplace for last year. Definitely the second half of last year, I would say. We got a lot of volatility, a lot of moves off CPI, and it was a lot of fun to trade. But this year, we have noticed that CPI has been a bit more muted, right? I can't quite pick out the days like I can last year to say, oh, this was definitely a CPI day. They're just not very much of a difference between CPI and then a normal trading day, right? And it kind of all blends together. And so, because of that, one of the trade strategies that I used last year quite a bit on CPI was the compound butterfly strategy. For those of you who are familiar with that, that is a class I taught here at Simpler Trading. It basically talks about all the different ways you can combine butterflies for a high probability trade. And so the one that we did quite a bit of last year was a combination of two debit broken wing butterflies to really take advantage of the potential volatility, with the idea that we're not quite sure how the market is going to react, positive or negative. But we know, certainly last year, that there was a high probability that volatility would be around that announcement, and so we played off that, and overall, that was a great strategy last year to do both off CPI and Fed, whenever Powell basically opened his mouth, and it allowed for some really great profits. But this year, we implemented it a couple times to try and see if we could get that same sort of movement, and it wasn't working out the same way. And so, certainly, this time when CPI came around, I even mentioned in the rooms that I was in that, hey guys, I'm not doing the compound butterfly strategy. It hasn't been working the same way. So it's a tool that goes back in the toolbox. And we pull out tools that are working in the current market environment. Because unfortunately, as much as we want to use the same strategy and setup every time that we trade the market, it's just really, at least in my experience, it's not viable, right? Because the market isn't the same every day. It's not the same every month, every year, right? It changes. It's a overall changing dynamic that it goes from bullish to bearish to consolidating as it ebbs and flows. And so this year, it hasn't quite a tool that's been working in the market, at least not two debit broken wing butterflies, I should say. And so that's been put back in the toolbox. And today I am very happy that we did not take that setup, because as you can see, right, we did not get that much of a bounce higher. And certainly, even though we have pulled back some, we basically went down right down towards the 10 period simple as support here at 40.93, held it, and we're not getting, at least as of we're not getting that 100-point range or anything like that. Now we do have Fed minutes out later today. Maybe that will cause a little bit of a movement. To be quite frank, I'm not anticipating that it's going to be a volatile move necessarily. Whenever minutes are released, they're a little bit different than when Powell actually talks, right? For example, here's when Powell talked last time. And so you can see that day, overall volatile range. Now, what was interesting is usually what we've seen last year is we'll have a volatile range and then a continuation when Powell talks. This time, we didn't see any sort of continuation for a strong bounce up or a strong bounce down. We had great daily ranges, arguably, right? That day was 103, the next day was 88. Then it started to go back down to a bit more normal, right? 63, got a bit more muted. Overall, all of these bars were basically in consolidation. We didn't quite break to the upside. We didn't break to the downside. It just stalled. And then later on, we got that little bit of a run up into the range that we're currently at now. So with that in mind, if Powell's not getting on to answer questions after the minutes are released, right? It's just the minutes themselves. Then as you can see, it will likely not cause as big of a movement, right? At least, like I said, that's not what I'm anticipating at this point. So overall, it still just appears to be a lot of chop, which for those of you who have been listening to me, I was really hoping I was wrong on the idea that maybe we don't see that volatility today. Because I am much more a trending trader. So I am ready for this to go back into a bullish bearish trend. I could care less which way it tries to go, but I'd like to see that trend start to pop up again. And though arguably on the daily chart, right, we are attempting to go back into a bullish trend, it is doing a good job right now of holding support. Momentum's overall bullish with room to move higher. Though the last few days we've seen a little bit of weakening in that momentum. The issue comes about with the weekly chart. So the weekly chart is not in agreement with the daily right now, which causes a bit of an internal struggle, if you will, between the one time frame and the other. Because as much as the daily chart wants to try and appear bullish, the issue with the weekly is we have some big weekly resistance levels above us that the last time we tested them, we were not able to break above. That doesn't mean the next time we test them, we can't, right? Overall, the market is a more bullish entity. So it would make sense that at some point we will break above the single higher. But this is the struggle that we have right now is the 100 period simples acting as resistance. We have the ATR trailing stop acting as resistance. And then even last year when we first started to fail, we attempted to break above the 100, short-lived, that failed. We tried for a second time back in August, attempted to break above it. That ended up failing and brought us down into the lowest year. And then since then, we haven't, at least as of yet, been able to break above it at all, right? We've gone up close to the range and tested it, but never broke above the 100. And then we had our pullback and now we're bouncing again. So we might get a chance to get another run into that range to the upside. Certainly the lower indicators are leaning a little bit more bullish right now. But when you look at this from a bigger picture point of view, you can just see the overall choppy range that we've been in the last steps. And I would argue it really started around probably November of last year to where we've just been kind of stuck in this chop since then. So if we can start to break above it, right, that will certainly help with a bit more of the bullish trend. If it holds resistance and then we can start to break these daily support levels, then that would add a little bit more weight to the bearish sentiment to the down. But right now we're just not getting much either direction. Those of you who have been following along with the quarterly analysis I have, then y'all know that based on some quarterly signals that have printed in the past, each time they've printed in the past, they've followed through, right? There hasn't been a time where it didn't, it printed and it didn't follow through. So it has a pretty good rate so far. That signal is pointing to more bearish sentiment at some point this quarter. Now, it doesn't necessarily have to happen the first month, but it usually um, happens at some point later in the quarter. Now, once again, I can't stress this enough. This could be the first time where this signal doesn't follow through that way. And so, no matter what, the only thing that we can truly control in the market is our capital risk. That's it. How much risk do we decide to put out there? And so, because of that, I do have some longer term bearish trades set at the end of the quarter looking for a potential move lower, but all of them are well within my risk in case that doesn't happen. My line in the sand personally is really started to break the 4,200, 4,260 range of that weekly resistance I just showed you guys. Then I'd be less likely to think that that move is going to follow through the same way it has in the past. One of the characteristics of these quarterly signals when they've printed in the past is that we open might move a little bit higher off the open, but usually the open of the quarter versus the high of the quarter, there's not much difference, meaning we don't get a strong run up and then it sells. Oftentimes it opens close to that high and then it might chop, it might start to sell that first month, but either way, it doesn't get much higher. And what's interesting to me is when we look at how, let's just go to a quarter bit actually, so it'll be a bit clearer there. But when we look at where we've opened the quarter versus the highs, at least as of now, it's lining up with that analysis, meaning we aren't too much higher than where we opened the quarter. And even the that we had today, and once again, that narrative might change by the close of today. But at least as of right now, what's interesting is the highs of today so far are still right in line with what we saw for the highs of the quarter last week when it was a holiday where it has a bit more of that bullish sentiment to it. So here, right, the quarter opened at 4102.20. The high of the quarter so far has been 4134.37. And you can see on the bar, not much of a difference, right? Not much of a difference from the high in that open. So doesn't mean it can't move higher. Like I said, that's why I have a line in the sand. If it really starts to break up, then the analysis might change there. It might be a clue that this is the time the signal won't follow through necessarily. But still overall pretty flat right now for the quarter. So we'll see if we do end up getting some of that selling that could happen, which is what we've seen in the past, or if this will be the first time it doesn't follow through. Either way, like I said, I don't mind which way this goes. I like to see it start to move some myself. Um, and then Matt, great question. So I have a few different trades on in Mastery and the $500 challenge account. Let me pull that up here. I do hold one of the trades in there. So, and then I also do want to talk about Apple as well. So just to go over that bearish, this one I don't plan to cut. If it breaks that line in the sand, I probably will hold it in case it still ends up selling off and it was just a higher bounce than I anticipated. But there are other trades that I hold in the Mastery that I do plan to shave if we break above that like 4260 level. But here's one of the bearish trades that I have on. So it's a 3500, 3460, 3430 put at broken wing butterfly, where the debit side of the butterfly is 40 points in width and the credit spread side of the butterfly is 30 points in width. I got into this for about $1.30, so I'm about half down on it because it's down 65 cents. It was a little bit profitable because we jumped in prior to the Fed news. So I mentioned on the mic and in here that if you had jumped into this trade with multiple contracts, you might look to take a couple of those off after the Fed news because it had that nice move down before we had this run up to where it allowed for a small profit. But otherwise, I'm just sitting on this trade and whatever happens with it, happens with it. The reason I chose these strikes is because based off the math from prior moves and how those have worked in the past, if we do see a similar percent move this time around, the more conservative target right now that I have to the downside is around 3,200. And so the idea is if we get down to 3,200, that's why it's a debit broken wing butterfly. If it goes completely in the money, it would settle for 10 $8.10 off of a $1.30 cost basis, be an 8.70 profit potential. So certainly not a bad risk versus reward there. And then if I am slightly off and let's say all we do is test the lows of last year, well, the lows of last year are around 49.90 or 34.90. Technically 34.91. So the idea is we're in the 3,500, but if all we did was go down and tap that level, it should be right at or in the money. And then certainly on a 40-30 point with broken wing butterfly, that too should still allow for a profit. So if you want to treat this like a lotto trade and kind of put it out there, you can certainly get a better fill than I did. But that's why I chose those strikes and kept it as a debit broken wing butterfly because of that initial targeting a bit lower than the lows of last year. The other trade that we put on more recently was Apple. And I put this on as a bullish trade idea with the thought, I can get Apple to pull up here. There we go. Yes, AD. So I'm about to talk about that right now with Apple. So we jumped into Apple. It was a very low risk, 52 cents, right in line with a $500 challenge account, right? So very small capital risk. And we initially jumped into this because we were making a bullish divergent bar the other day. We had a one that was still in play from a couple days ago for a move higher up towards 65. And so the idea was if we could get both of those to follow through with the higher high the next day, and there's the high, that's where that's 165.05. So if we could get this bullish divergent bar to follow through with its higher high and the one that printed the other day, it would allow for a really great risk versus reward on profit. Unfortunately, what happened yesterday is follow through on this bullish divergent bar, but we couldn't break above the 10. And so this one never got the follow through that we were looking for, unfortunately. And so obviously, we're not seeing that increase like we want to see on this out of the money strike. Today, as you can see, we did follow through with the slight lower low. Depending on how we close, we might make another bullish divergent bar. But of course, the issue that we have right now with holding the 165 strike is that we really need a push to the upside. So unless we can get a break above the 10 period simple today or tomorrow and really get that push to test that level, we are getting it basically by theta K on our trade. It's not helping us out at all. And instead, of course, what we're seeing is back-to-back divergent bars are a sign of consolidation. Momentum pulling back is a sign of consolidation. Bollinger Bands are flat, right? So all of that kind of lines up with each other to where we're just seeing a lot of chop. So one way to go about managing this, I do not plan to do this in the $500 challenge account just because I already know it's going to cost capital. And so I just am okay already taking that 52 cents of risk and we'll probably let that go. But if you have this in a different account and want an idea of potentially how to manage out of the trade, there are a couple things you could look to do depending on where you think this is going to be. The first way to go about this is to turn this long call into an iron fly, something that matches the more choppy narrative. Now, there are ways to go about that. The first way is to go out here to the 160 strike, right? That's kind of been the support level that we've had recently with the last couple of days. And the idea is that's where we'll still hang around. So to turn this into an iron fly, you would be selling to open the 160 call that pairs with the 165 put. You're also selling to open the 160 put and then buying to open the 155 put. Right now, that brings on about a 278 credit. But keep in mind, you already have the long call at I filled at a 52-cent debit. So the way that you'd figure total profit potential and risk is you take the premium that you're receiving here, which is 278. We're just going to go off the mark. You take away from that the cost basis of the 165 call that you already hold, which is 52 cents. And so you're in this trade basically for a 226 net credit. And in turn, that means you're increasing your risk from 52 cents up to 274. So that's what I mean by it's not a cap positive move. Usually when I look for management moves, ideally I like it to be capital positive where I'm bringing capital back in and preserving it. But sometimes if you're wanting the not what I meant to do, if you're wanting your trade to now match up with what the technicals are showing us, which is for us we were looking at a bullish trade idea and now we're more in consolidation. So we want to switch our more aggressive bullish trade into something that benefits from chop, then this might to go about it, right? It's going to cost you an additional 220 of capital basically, but it flips your trade from a pure directional trade into a more consolidating trade. And if all we did was hang out here going into the close of the week, then theta decay should continue to work in your favor and you should be able to cut this for break even, if not a profit. So that's one way to go about it. However, like I mentioned more recently, this 160 level the past few days has been attempting price support. So if you wanted a bit more of a narrow iron fly, you could look to sell the 162.50 as your short strike and then buy the 160. This keeps the spread width the same on each side. And so as we can see here, if you took this action instead of the one I just went through, it's going to cost less capital, but it also is less profit potential too. So pros and cons to both. So this brings on a 185 credit. Once again, you have to keep in mind the cost basis that you already hold on the 165 put, which is 52 cents. So 185 minus 62 is $1.33. So that's the new net credit and profit potential on this more consolidating trade. And then 133 minus 250, which is the spread width, means that you have a risk of $1.17. So that's a little bit better, right? You're bringing up your risk from 52 cents and you're adding 65 cents of capital to turn it into a non-directional trade. So that's a little bit easier on the capital cost compared to the 5-point spread. But of course, you're giving the underlying price a lot less room to move to try and make up that profit or get back to break even, certainly. However, like I said, if this ends up closing in a bullish divergent and we're still struggling the next day, even if it follows through the higher high, if we still struggle to break above 163.26, which is currently where the 10 period simple is, then this might be a great way to save the trade and either recoup your capital for a break even fill event or to still be able to net an overall profit. So let me know if you guys have any questions around this management move. You would not open a new 165, just as a reminder, guys, right? You already hold it. And let me just show y'all what this looks like in here, because good rule of thumb, in my opinion, your cash buying power shouldn't look dramatic like this. If it looks dramatic like this, it means you're doing something wrong, right? AKA in this account, I don't hold the 165. So if I'm doing this trade, it's going to cost me all of a sudden a huge amount of cash buying power. Whereas if I took this action here, and this is going to be a bit weird, I have to treat it like a butterfly, but then we're going to go to custom so we can modify each strike. And what we will do, let me try and make this a bit bigger so you guys can see it. Okay, if it's going to, there we go. So obviously the contract amount even on our sell to open strike. If we're doing the smaller width spread, for example, we'll do 62.50, 162.50, and then our bot to open strike will be 160. And then we'll just need to remind ourselves that one of those is on the call side and the other two are on the put side. So notice it gives us that 185 of credit. If I were to go to confirm and send, it should show up as a, okay, it's showing it weird, but basically it should show up in a way where it's a small debit of cash buying power. I don't know why it's showing it like that there. Do I have the right expiration? Yeah. So I don't know why it's showing up like that, but usually it shows up to where the cash buying power pops up as 65 cents, right? Where it shows you that all you're adding on is a little bit of additional capital rather than a crazy amount of capital like Tastyworks is currently showing because I don't technically hold that trade. Um, and so that's how that would look as a management order, if you will, to put that out there. So, okay. Stuff for me for a second, so let me catch up with the chat here. Um, yeah, of course. AD, always happy to share my 2 cents. Matt, most of the bearish trades basically I have a bearish trade in the SPY around that 3,500 level and in the $500 challenge. And then the other 2 trades I hold are in SPX and they are further down closer to the 3,200 level. And then I cut maybe the Apple trade should be rolled into a longer dated strike price. That's absolutely, you could look at that too. So if you think that the trend will overall stay bullish, if you think the market is going to continue to bounce from here, you could absolutely look to just give yourself more time on a long call and push it out further in time. The hesitation I have with that is that it just goes back slightly to that quarterly analysis. I'm still not sure whether or not that's in play. I also don't quite have bullish signals telling me like, yeah, let's get back into this, right? We don't have green momentum necessarily. This is still a pullback signal. And so if you're wanting to manage this trade short term to keep it within this expiration, turning it into an iron fly, I think is a good way to consider managing the trade to match the current market conditions and still allow yourself maybe a profit. And so VA, this was management action for the Apple trade we hold. The reason why I started technically with a butterfly is because I need 3 strikes, and then what I did is I went to custom because I'm not actually building a butterfly. I'm pairing these 3 strikes with the long strike that I already hold over here. And then pairing it with the long strike I already hold is what flips it into an iron condor. Yeah, Chad, I that's why I usually show you guys and trade more out of Tasty Trade just because Thinkorswim, their platform is a little sometimes slow and it can be a bit difficult, but I hope that makes sense. And then Earl, yeah, I mean, there are a lot of different ways that you can look to play the more bearish trade idea for the quarter. Just keep in mind, one, it may not follow through. So I would, just like I did in my account, I would still keep my risk really and then 2, be technically okay losing 100% of that capital because let's say our line in the sand is 42.60. If we rip up there to that level, those trades that we hold may not be worth a lot to where there's not much capital left to save in them. Um, but that being said, I think a great way to go about doing trades like that is, 1, I would still go to the end of the quarter because sometimes and all my windows disappeared. Hold on, guys. That's so frustrating. Sorry, give me a second to get up the rest of my windows here. But basically, that we talked about helping manage this would be to do just like we did in the $500 challenge account, is to go with debit broken wing butterflies, right? Those are a great way to the move happens quickly, well before the June 30th expiration. The debits style of the broken wing butterfly can still allow for a very nice profit, but at the same time, butterfly relatively inexpensive, so it can keep your risk on the small side and allow for some great risk versus reward. So, like I mentioned, the trade that we currently have on in the challenge account is the 3,500, 3460, 3430. It's only 65 cents right now. So like I said, you can get in cheaper than what I got into it. You could, of course, given that it's less expensive, if you're okay with a slightly higher risk tolerance, maybe you make this a 150-point spread butterfly. Right now, obviously, that added up the capital sum, but it also increases that profit potential a bit. Of course, bring this side down to where it's now a 10-point spread with difference 190 points rather than the 40, 30 that I have on. And that's about $1.70 with a very nice profit potential. With the idea that if it doesn't work out, you're okay with that risk. It's very small. It shouldn't blow out your account. But if the signal does end up following through, it gives you some very nice risk versus reward parameters to help out the account with. So AD, the great question. So AD is asking back over on Apple, would I not consider going into a vertical spread? The reason I personally wouldn't is keep in mind our cost basis, or at least my cost basis on the 165 strike is 52 cents. The premium that I'm bringing on here by selling the 162.50 is only 2 cents. So basically what that means is when I combine two strikes, it's oh, I'm sorry. So 82 minus 52, it's an only a 30-cent credit, right? It's a very small profit potential, and in turn, the risk on that trade is 220. That's not a risk versus reward scenario I like to see. So that's why I would keep it an iron fly. Now, if this looked like it was falling apart, right, and it was dive bombing, then yeah, I wouldn't wanna call credits or put credit spread on to, to basically work out if it's going to be going down to 1 by the end of the week or something like that. But everything about this chart is still just consolidation, right? There's not really a strong directional move lower that we're looking at, and unfortunately not necessarily a strong directional move higher. That might change, but right now what we're seeing is just signs of consolidation. So an iron fly matches with that sign of consolidation, and of course it's a much cheaper capital cost to do this trade. For the 2.5 with butterfly, when we walked through the numbers, it's only about a 65-cent additional cost to your account. So you're only adding on 65 cents more of risk, bringing it up to a 117 risk on a 2.5 with spread versus having a 220 risk and only a 30-cent profit potential. So this iron fly, 133 of new profit potential versus 117 of risk, not a bad first reward. Same thing with if you went with the 5-point spread width, right? Now here you're definitely adding on more capital, um, but it's still a nice risk versus reward. You have a 226 profit potential versus a 278 risk. Um, or no, I'm sorry, you would have a what is this? 282 minus 50 52, a 230 profit potential versus the 270 risk, and then you're adding on an additional you're adding on an additional 218 of capital. So it's a definitely a higher capital cost, but unlike the credit spread, right, which arguably it's a similar capital cost to the credit 220, but your profit potential looks a lot different. It's a 230 profit potential just versus a 30-cent profit potential. So between the chart technicals telling us more consolidation, um, with a I would argue a bullish bias because the trend is bullish, versus playing the pure credit spread to the downside. That's why I'd look at it that way myself. So if that answers your question. Yeah, I kept absolutely. So that's one way you could are managing it. Now, like I said, because I did this in the $500 challenge account, I need to be very mindful of the capital I already have at use, right? I had $1.30 currently tied up in the broken wing butterfly, and then I have 50 Apple trade. So I don't really want to put more capital into this trade personally to manage out of it. If this was in my main account, I'd be all for trying to maybe flip this into the 2.5 with spread and letting it go about. But because this is in a very small risk amount, I don't feel like adding more capital risk to this trade in general. So I'll either potentially look to cut trade. If it makes a bullish divergent bar, I might give it one more day, see if maybe the market reaction to all of the news today, CPI and minutes, has a follow-up day tomorrow of a positive reaction to maybe bounces back up towards 165. But I'm not holding my breath on it, and that's part of the reason why we took the trade, right? Because it was really small risk to begin with, so I didn't mind it. And then Matt, so usually start with $500 at the start of the if I am profitable by the end of the month, then I take out all the profits and restart with $500. If I lost money for the month, then I bump it back up to $500 at the start of the next month and then look to trade from there. So I usually reset it each month for the $500 challenge. This time, however, at least for this quarter, I'm doing it a bit different where I'm doing it $500 for the entire quarter. And a part of that is because I really wanted to jump into this quarterly trade in case that follows through the way I was looking for. But obviously, prior to this, I usually kept my trades within the same monthly period. So even if I had a swing trade, it usually stayed within the month and I'd be out of it by the end of the month. So because of the quarterly analysis and what I'm looking at there, I decided for the current $500 challenge that we're in to set it up for the entire quarter. So that's why I haven't been as active in the trades recently in that account, and I've been a little more picky about what I'm jumping into versus what I'm not at the moment. But I hope that makes sense. And perfect, AD. Perfect. Glad that answers the question. I I appreciate it. It's taken, it takes time to learn these things certainly. But basically flipping that from a long call into an condor, it's what I call profit recycling as management, right? It's knowing the different option strategies and how to flip from one into another, whether it's a management move like this or whether it's to protect capital and lock in profits and set up bonus trades. I think it's a really good advantage of having that knowledge, because it gives you a lot more flexibility on how you can manage trades, especially if it's a capital positive move or it stays within your risk tolerance, versus jumping into a trade and then just hoping that it works in your favor. And if it doesn't, having to cut it, which there's nothing wrong with that. And for example, that's how I'm planning to do this Apple trade. But if you are in a different size account, right, there are ways to sometimes manage out of what appears to be a losing trade and still have it work in your favor. So, and yeah, that we'll see how the minutes work. We'll see if it helps with a pop-up or if it is a non-event. I'm anticipating it to be a bit more of a non-event. So that's not to say that off the original minutes we may not get some movement. So for those of you who are newer to trading or maybe haven't traded around Fed, stuff like this where it's either Powell's getting on the mic to talk about rate cuts or rate hikes or it's the minutes, it's not uncommon when the news is first released to get a little bit of volatility, and the spike in direction one way or the another. Oftentimes it's in both directions. It will spike up and then the algos will bring it down and then they'll bring it back up. And then they'll eventually choose a direction typically to trend in. But minutes aren't as common with that just because, like I said, Powell's not actually coming on the mic to answer questions. So that extra bit of volatility that happens 30 minutes after the news is released will not happen today like it did last time. And then the second thing, in more bullish trends or in chop trends like this, sometimes you'll get that spike of volatility in both directions, but then ultimately going into the end of the day, we're stuck right back in the range that we were in prior to the news, right? AKA it's more of a non-event. And that's to me right now, just looking at how that's been trading, how it acted off CPI, that's what I'm anticipating a bit more of, is that it's going to be a bit more of a non-event. So we'll see how it plays out. I would love to see it be a trending move and to get something going on a daily chart, but I do not my hopes up after what CPI did this morning, certainly. So let me catch up on the chat here. Perfect. Glad that makes sense. And then any interesting scans today? It seemed like a weak market for any good trades. I really know it's hard to say. Certainly, right? If you're looking at the move here, it seemed like a weak market. But when we look at the daily chart, all this is a pullback into 30. It held and we're bouncing again. Do see some signs of exhaustion. To me, this is just a chop market. And I am not a fan of trading chop. And it could be that this is a year of chop, which if that's the case, we'll need to be mindful. Like I mentioned in the profit recycling update that I sent out right before jumping in here, it might mean go into our toolbox and look for more theta decay friendly trades, things that benefit and chop, as it could be, as much as I don't want to see this, let's just go to a longer time frame monthly chart. It could be what was it, 2018? If I'm remembering the year correctly. I'll find out whether I'm right or not in a second, but basically, it was a little while ago, um, where there was like a year to 2 years where we were just in this consolidated range. And now obviously we had ebbs and flows both to the upside, but when you take a look at a bigger picture point of view, we were not in a bullish or bearish trending market. We were in a consolidated market. And so it can be a bit frustrating to trade. Oh, I was thinking, no, 2015, 2016 is what I was thinking. So as soon as the indicators pop up, you'll see it a bit more clearly. But very clearly, right, the market is generally a bullish beast. That's the natural course of things, is that we just go up, right? We have our pullbacks, right? We have our years or moments where the market needs to reset, and that makes sense. We talked about this at the end of 2001 going into 2002 that, hey, there are starting to be signs of exhaustion. Looks like we're at the top of the axis. We need to be mindful of a pullback where either the market's going to pull back or it's going to chop. In this case, we got a bit, a little bit of a pullback here, certainly. And now it's reset by quite nicely, but still a lot of consolidating signals. And what happened here is what could, in fact, happen maybe in a slightly wider range because we're trading at higher levels, but it could just be this, right? Not that I really want it to be, but we have to be open to that possibility, which is basically in 2015, 2016, we're in overall chop. We had some months where we got a little bit of a pickup in range, but we really didn't quite move. I would argue it wasn't a strong pullback kind of a situation, right? It wasn't like a bear market, but it never really got going into that bullish market. We couldn't really break the highs that we were typically looking for. It was just a lot of more narrow ranges and overall chop. And then after we got out of that, right? Because consolidation, just like with the pullback, can allow bullish exhaustion and momentum to reset to the zero line. So that's what happened during this consolidation is momentum got the reset it was looking for. Then we started the pickup in momentum. We started to get the bullish signal in the compound breakout tool again out of the consolidating one. And then we had this great squeeze, which started to fire to the upside. And then we know what happened from there, right? We had a nice bullish trend the next couple of years, had a few pullbacks here and there, but at least the overall trend maintained a bit more of that bullish sentiment until really going into COVID. And then that's when we had that stronger pullback again. So unfortunately, it could be a case of that where we do find ourselves stuck in chop a lot longer than any trending trader would like to see. And if that's the case, then once again, not every market environment is the same for every strategy. So if we are going into a bit more of a choppy market longer term, to either one, if we are being directional, be very respectful of the levels that we have, AKA if we're at 4,100 and things are turning bullish, then we only play it up into 4,200, right? We only play up into the next level of resistance. And if we get any sort of stalling, you take the quick win. If it looks we're at 4,200, it's reversing, then you short from 4,200, right? Back down into 41. And you play the levels like that a bit more directionally. The other way to go about it is you do theta decay style trades that benefit from chop and from overall consolidation. Um, and so I've been personally, I've been putting that off a little bit, arguably, because I like to be more directional. So I've been trying to find individual symbols to help out with those directional picks a bit more. But sometimes, you know, that's just that might not be the market we're anticipating this year. And if that's the case, to be prepared with some strategies that are going to fit that type of market a bit more. And then, great question. So over on YouTube, they're asking, what is my setup for day trading? So this is usually the grid day trading across all different sim futures and um, individual stocks or the indexes. And so I have the 1 minute chart up on this side, the 5 minute chart, the 10 minute chart. Those two stay consistent. And then on the far end over here is the hourly chart. Sometimes I'll flip it down to 30 minute, but more recently I've been keeping this on the hourly perspective. And so I'll use the 5 and 10 minute chart usually to guide entries. The hourly chart I'll use for overall perspective and levels, and I'll use it for divergent bar entries, which I'll take from time to time if the settings. And the 1 minute chart, you can really try and time it to give you the break of an entry or exit. But normally I look at the 1 minute chart um, and pay attention to it on more volatile days, which we're not having recently. But on volatile days, it can feel like the price is just trading along the Bollinger Bands, right? You never get a pull back into resistance or into support to give you that proper entry to then jump into something. But the 1 minute chart will actually give you those pullbacks into simple on volatile days. And so, like last year, for example, I took entries off the 1 minute chart when we had those more volatile days, and it helped out with me still being able to jump into a trade from a technical perspective, while all the other time frames that I normally looked at and get the pullbacks that I was looking for. As far as the indicators that I use on my intraday charts are the same that I use on my daily, which we do have a video that lives out there, I think on YouTube, but certainly also in the free trading room. That's called What's on My Chart and Why. And I walk through all the different indicators I use and why I like to use them. But I have Bollinger Band, simple moving averages, awesome oscillator, ATR trailing stop. All of those are free indicators. Then the paid indicators here at Simpler that I use are the compound breakout tool, Squeeze Pro, Divergent Bar, and those are and the multi-squeeze is nice because it helps identify squeeze on multiple time frames without having to flip through all the charts. But those are the main ones that I use in general across all my time frames when I'm trading. So I hope that kind of helps answer your question there. Yeah, and Chad, I agree. There's just not many strong trends. And then do I use the voodoo lines? I do. I don't have them up on these charts, but I have multiple displays. And so the voodoo lines, when people come at me with fib levels and say, hey, we're near like a 618 retracement or something, I definitely write those down and I'm very mindful of them. Especially when they're in line with indicators that I already am looking at, right, on a standard basis. I think that certainly helps out. The more that's an agreement, the better. So yeah, I do like the voodoo lines. I need to add the micro voodoo lines because I've heard some pretty good things about those recently. So I need to get those added to my charts. But I don't, just to keep things a little bit more organized, right? So it doesn't look like a hot mess on all my time frames. I use those on other charts on other displays, but they are certainly helpful. I cut. And yeah, it could be Matt. So that's a great point too. Earnings is coming up soon. Could be that we're waiting on earnings season to get a little bit more of a move. Usually the first ones coming out around earnings are, and correct me if I'm wrong, guys, but outside of like what Netflix is coming up, outside of like a bigger name like that, usually it's the financials that start off first. And so maybe with the whole Silicon Valley Bank thing that's happening, the market's kind of taking a pause until they jump out with their earnings. And then once they do, right, whether they're good or not, doesn't matter. It's how the market reacts to that news. If the market reacts positively, then maybe that will start more into a bullish trend, taking us up into W200 again. If it reacts a bit more negatively, maybe that brings us back down. Um, but yeah, we're kind of waiting on earnings season to get us going. And JPM reports Friday. That's what I thought. Yeah, Tesla's pretty early on next week. Amazon and Google later in the month. Tesla, Netflix is the 18th as well, so that's coming up. So we will see. It will be interesting to see what happens. I feel like though part of me just keeps going from one catalyst into the next. Like I was like, okay, last news when Powell talked, maybe that will be the catalyst for a move. And I guess arguably it caused a little bit of a run up, but not really much of a trend, what I'd call a trending move. And then it was like, okay, maybe CPI will cause a bit more of a move after we get out of the market holiday. And that is clearly acting as a non-event right now. It's like maybe minutes will help out later today, but it maybe it will be earnings, maybe us out. If I say that though, and we're still stuck in chop, then that just me in that it may just be another re redo of 2015, 2016, where we're just stuck in chop for the year. So all things to be aware of, certainly. And then I do use Thinkorswim. I definitely use Thinkorswim for my charting. That's my main charting platform. And then I do have the $500 challenge in Thinkorswim. But I will say the majority of my trading is done in Tasty Trade. It's where I do most of my trading setups. Um, and for those of you who are interested, I do have a link you can use if you want to. Which I'll post here in the alert section in a second. There we go. Sorry, guys. Things are running a little slow on me today. Usually they're a bit faster for me, but let me find that link and I will get it to you guys. And then for those of you interested more in that quarterly analysis stuff that I talked about, I believe in the documents folder here in the free trading room. I know it's definitely in the options room and definitely in the profit recycling mastery. But I did take notes on like handwritten notes on that quarterly setup and how it's followed through in the past, as well as let me get this link out. So here's a link for Tasty Works if anyone's interested in signing up. Um, but in the room drive, so if you go over here and you're in the free room and you click on the folder, that's the room drive. And then it should here under images. Let's see if it is. It doesn't look like it. Maybe under files. It should have been added. I'll try and get it added if it's not in there. Um, geez, this is acting really slow. Yeah, it doesn't look like it's in there. So though there will be some files added of the screenshots of my journals that give targets and different percent moves that we've seen in the past. Certainly, if you haven't watched the longer free video I did a little earlier this year, right before the start of this quarter, please feel free to check that out. And it goes through all the different targets and levels and goes more in depth into that quarterly analysis that I was talking about at the start of the day. But that is my time, guys. So thank you so much for joining me. As always, may the trade be with you, my fellow Jedis. And I hope to talk to you guys again next time. And if I do take any action on that Apple trade or on the SPX trade, I will certainly alert it out and let y'all know. But otherwise, have a good one. And please, please, please be mindful of the potential chop as well as your risk going into the rest of the day and this week, given how CPI acted. But have a good one, guys. Bye.